Hey, what's up, everybody? It's Justin.atteberry. It's your favorite Texas mortgage dad. I hope you're all having a really good Friday. I had a fun start to my Friday. I got to be a part of a Q&A panel with Goosehead Insurance. They dabble mostly with auto insurance and homeowners insurance. And so I got to be a part of this Q&A panel where those agents were asking me questions and I was answering those questions. And a lot of that's really geared to how they can help you as a consumer to save more money on your homeowner's insurance policy during a refinance process. And I'm one to believe, and this is not what I want to talk to you about today, but I just want to kind of touch base on it just for a moment. I fully believe that if you are buying a house, obviously you have to get homeowner's insurance, a policy on that house. But if you're doing a refinance, that is one of the best times to also take a look at your current policy to see if that's another area for you to save more money. Most of my clients that do this, if we're able to save them, say $200, a lot of times we can increase that savings from $200 to $250, $275, maybe even $300, depending on what your policy is. And it's a really good time to look at that. So if you have questions on that, if you're wondering if you're paying too much, give me a shout. I'm going to get you in touch with my insurance agent. Her name is Taylor, and she's the best. I really mean that. I don't refer anybody else but to her. I don't get a dime out of it other than satisfaction that you're going to save even more money. Anyway, so what I want to talk to you about today is wanting to continue in our discussion on VA loans. Last week, we really kind of touched base on the funding fee. So again, if you are a veteran, you do have to be a veteran to qualify for any VA loan. So that could be active duty, separated from service, or a surviving spouse. So if you're doing one of those, the funding fee, if you do not receive VA disability, you're going to have a funding fee. So if you missed that information, go back to last week where I talked about that. It's just a couple minutes, a lot of really good information in there. If you do receive VA disability, then your funding fee is waived. So today, in the continuation of the VA discussion, is going to be on what's called it's a streamline refinance. We call it an IRRRL for short. That's interest rate reduction refinance loan. And an IRRRL is highly beneficial to any veteran that has a higher rate than where the market's at today. Okay, so and I would say anyone with a 3.375 or higher interest rate, and you're a veteran, you really should be looking at your options on a refinance because rates are below 3. I think most of these VA loans sit around 2.5, 2.625, and it would really benefit you to save that much money. You're talking upwards of $50,000, $60,000 in interest, which is a lot of money to save. So anyway, on a IRRRL, interest rate reduction refinance loan, again, if you do not receive VA disability, then you're going to have a half of a point or half of a percentage funding fee. Okay, so remember last week, if it's your first time to use the VA benefits, then you have and you don't receive VA disability, your funding fee is 2.3%. If it is your second time, then the funding fee is 3.6%. Okay, on a IRRRL, it is completely different. All right, it's a half of a point, so basically $500 per $1,000, $100,000. Sorry, so $500 per $100,000 loan amount. Yeah, and that's just placed on top of the loan. Okay, so it's not a fee that you pay out of pocket. You can definitely pay that out of pocket if you wanted to. Most people don't. They're just wrapping that into the loan. Okay, but if you do receive VA disability, again, it's completely waived. You do not have a funding fee. So why is a VA IRRRL, a streamlined refinance, beneficial? Well, number one, it's really fast, like super fast. Even in a low interest rate market like we're in, these are done much faster because number one, we don't have to do an appraisal. Okay, we get to use the value on when you bought the house or the last mortgage transaction. We get to use that last home value, and that's what everything's gonna be based off of. So there's no appraisal. That saves you $500 right off the bat. Then also, we do not have to verify your income. You're already in a VA loan. It's just taking you from one VA to a new VA with a lower interest rate. As long as you've been making your payments on time for the last 12 months, unless you've been in the house less than 12 months, you would need, it's a 210-day rule. Okay, 210 days from the last mortgage transaction, you are eligible for this. So again, we don't have to verify the income. With COVID, okay, so there's a slight little caveat. With COVID has tightened up some restrictions. A lot of mortgage lenders will verify that you are still employed. Okay, they're not verifying the income, so there's not a debt to income restriction, but they do want to verify that you are still employed. Okay, and that's a good thing. You don't want to get into a loan when you're not working. Okay, that's not going to help you out. All right, but again, so no appraisal. There's no income verification. It's a very, very quick process. There's actually just very minimal documentation that's needed, which is why it's called a streamline. All right. If you have questions on this, give me a shout. You know how to get a hold of me, www.texasmortgagedad.com. Again, I'll put all my contact information in the video. If you have questions on this, reach out to me. It is my joy and my pleasure to answer your questions. Take care.